Welcome back to The Explainer. Today we're undertaking a really rigorous investigation into a company sitting at the absolute center of the enterprise software universe. Right now, there's just something kind of strange happening with ServiceNow. Because, on the surface, the numbers look like a flawless victory. But beneath the hood, there's this profound financial mystery playing out. So we're going to break down the actual investment reality, strictly using the latest verified company and market data. Let's get into it.
All right, check out this quote, because it captures the central tension of our entire investigation. A company can grow 25% and still be a terrible investment. Read that again. We so often conflate a great business with a great stock, right? But the reality is, they're driven by two entirely different sets of physics. Today, we aren't just looking at the flashy headlines or the shiny new AI story, we're looking at the actual math behind the hype.
Which brings us to Section 1, the ServiceNow paradox: great numbers, weird stock behavior.
So before we can even try to answer whether this stock is a smart buy, we've got to establish the raw financials and just clear away all the noise. What is this business actually doing right now? Well, they're generating almost $4 billion, specifically $3.987 billion. That's their Q2 2026 total revenue figure. But what's truly interesting here is the growth rate behind that massive number. It represents a 24% year-over-year jump. Their subscription revenue alone was nearly $3.9 billion, up 24.5%. Think about that. Recurring revenue, high growth, massive enterprise customers. Literally the exact profile every software investor dreams of seeing.
But this brings us to the core contradiction we need to solve today. If the numbers are that stellar, and if ServiceNow is becoming this indispensable enterprise AI platform, why in the world did the stock spend so much of 2026 getting absolutely hammered? It was trading dramatically below its previous highs, down about 16% for the year at one point, before it suddenly mounted a massive 29% rebound in a single month. No way a stock behaves like that without some serious underlying tension. To understand this wild volatility, we first need to really understand the product.
So what does ServiceNow actually do? Imagine a giant, chaotic corporation. Employees need IT support, the security team is drowning in alerts, HR has literally thousands of onboarding requests, and valuable corporate data is just scattered across dozens of disconnected applications. It's a mess. ServiceNow simply sits right in the middle of all that chaos and turns those fragmented processes into one connected, automated workflow. It's basically the central nervous system for modern corporate operations. And once it's installed, it is incredibly sticky. Moving on to Section 2, the $1 billion AI engine, accelerant or expectation. Now, customers love this platform so much that ServiceNow has built up a staggering $29 billion in total remaining performance obligations, or RPO. Basically, that's contracted revenue that just hasn't been recognized yet. But while that creates incredible predictability, predictability isn't necessarily the same thing as growth acceleration. The market wants to know, can AI make this massive engine accelerate again? Well, ServiceNow has made a really bold claim that investors can actually measure. Their AI business has crossed a magic number, $1 billion. But, and this is a completely crucial distinction, this is annual contract value, or ACV. It is not $1 billion of quarterly revenue. That distinction matters immensely if you want to be a credible investor. It proves they are selling AI for sure, but how exactly are they doing it?
These Q2 2026 metrics show us exactly where the money is coming from. Look at this. They secured 123 net new transactions worth over $1 million in ACV. That's up nearly 40% year over year. Plus, they now have 658 massive customers spending over $5 million annually, which is growing at 23%. So they aren't just selling some new AI app to random startups. They are successfully upselling incredibly expensive AI packages to the absolute heaviest hitters in the global economy.
And this brilliantly illustrates their true superpower. The monetization flow is genius in its simplicity. Step 1, you start with the existing customer base. Step 2, you add integrated AI functionality. Step 3, charge a much higher contract value for it. And finally, Step 4, the customer becomes even more dependent on the platform, which leads to a massive increase in lifetime value. Because ServiceNow already owns the enterprise relationship, their AI is far more economically powerful than some standalone AI application trying to win new business from scratch.
This entire setup creates a phenomenal defensive moat. I mean, why can't Microsoft, Oracle, or some hot new AI startup just come in and destroy this business? Because ServiceNow's workflow integration is already deeply embedded across multiple departments. The switching costs to rip them out are astronomical. Furthermore, ServiceNow holds all the valuable corporate data context,
wrapped up in the strict enterprise-grade governance and security that massive corporations demand for AI deployment. The moat is undeniably deep. But here's the trap. A deep moat doesn't actually tell you what a stock is worth.
That brings us to Section 3, the cash flow reality, claims on the future.
Look, revenue growth and AI hype are super exciting for the headlines, but as investors, you ultimately own a claim on future cash flows. Looking at the actual financial engine powering this machine, these fiscal year 2026 non-GAAP targets are just staggering. An 81% subscription gross margin is absolutely world-class, but the true star here is that roughly 35% free cash flow margin right alongside a 31.5% operating margin. If ServiceNow can actually continue growing top-line revenue at over 20%, while throwing off 35 cents of free cash for every single dollar they take in, well, that is a compounding machine of epic proportions.
Let's head into Section 4, the valuation trap, the price of perfection.
All right, so we've firmly established that the company itself is phenomenal, but now we have to ask the really uncomfortable Socratic question: how much of this incredible compounding future growth is already baked into today's share price? Are you essentially buying future success before it even arrives? I want you to remember this concept every single time you look at a high-flying tech stock. The market doesn't pay you because a company is great. It pays you based on the difference between reality and expectations. If literally everyone already expects ServiceNow to be great, you don't get rewarded when they simply meet those expectations.
This market snapshot from August 2026 perfectly illustrates that exact tension. At the time, the stock was sitting right around $128.48, giving it a $132.8 billion market cap. But look at the multiples. An 80 times trailing price to earnings ratio? That looks terrifying. However, the forward PE drops dramatically to about 31 times. So why the huge drop? Because Wall Street analysts already expect massive, rapid earnings growth over the next 12 months. The perfection is largely priced in.
And this right here is why we absolutely have to separate these two concepts completely. On the left side, we have business risk. This means revenue growth slows down, maybe AI becomes commoditized, or aggressive competitors like Microsoft and Salesforce steal market share. But on the right side, we have stack risk. This is multiple compression. Listen, even if the business executes perfectly and earnings rise, the stock can still fall if the broader market simply decides to pay 20 times forward earnings instead of 31 times. A great business can absolutely be a terrible investment if you buy it at the wrong price.
Which leads us to our final section, Section 5. The final verdict, the $150 question.
Right now, investors are totally obsessed with one specific question: can ServiceNow reach $150 a share? From our reference price of roughly $128.48, the stock requires a 16.8% gain to hit that magic number. Let's just walk through 3 potential futures to see how we might get there. In scenario A, growth stays strong at 20+%, AI monetization expands, and the valuation multiple remains healthy. Boom. That is your path to 150. It's a potentially bullish outcome. Now, in scenario B, growth slows moderately to the high teens, margins stay strong, but the valuation multiple compresses. Suddenly, those gains are much more difficult to come by. And in scenario C, enterprise AI spending slows, competition bites, growth falls sharply, and the multiple collapses entirely. That is a scenario with serious downside risk. So you see, for the $150 bull case to work, several highly optimistic actors must go right all at the exact same time.
So here is your final investor scorecard. Notice something really striking about this list? Almost every operational metric for the business is flashing bright green. Revenue growth? Strong. AI monetization? Emerging and strong. Free cash flow margins? Super strong. However, competition from deep-pocketed rivals remains a significant threat, and most importantly, the valuation is in critical territory. The company's fundamentals are remarkably robust, but that valuation, it demands absolute perfection.
Because of that, we aren't going to give you some single clickbait target price today. Your verdict should be assumption-driven based on this specific framework. Think about it like this. It's a buy only if your personal valuation model produces sufficient expected return, even after accounting for the risk of multiple compression. It's a hold if you believe the company is truly excellent, but that the current price already captures all that expected growth. It's a watch if you demand a larger margin of safety and you're just waiting for a better entry point. And it's a sell only if the actual business thesis materially deteriorates, not merely because the stock feels a bit expensive today.
Which leaves us with this final provocative thought. ServiceNow's biggest opportunity may well be artificial intelligence, but its biggest investment risk is something much less exciting: expectations. A company only has to execute on its plans. But for you to make money, the stock has to outperform what the market already expects it to do. And trust me, those are two very, very different challenges. It's the ultimate difference between owning a great company and making a great investment. Thanks so much for joining me on this explainer, and I hope this framework helps you cut through the noise